Hello Accounting 101 students. In this video, we are going to go over how to prepare the net cash provided or used by operating activities section within the statement of cash flows, and this video will focus on the indirect method. So to demonstrate this concept, we're going to be using question 4 in the chapter 12 end of chapter practice questions. So in this problem, you're going to be preparing just a portion of the statement of cash flows, and you're given information about the company's current assets and current liabilities from the balance sheet. And you will notice that you're also given some additional information at the beginning of this problem on the company's net income and their depreciation expense. So what I'm going to start off with is just writing out the information from the income statement. And from the income statement, we know that the net income was $162,180 and depreciation expense was $28,620. And this is going to be important a little bit later as we go through our problem. So when it comes to the statement of cash flows, there's two methods. There's the direct method and the indirect method. The indirect method assumes that most of the company's operating activities will be reflected in the net income, as in most of the revenues have been collected in cash, and that will affect the statement of cash flows. And most of the expenses have been paid in cash, and that will affect the statement of cash flows. So what we do with the indirect method is that we take our net income as the starting point. And then we need to make some adjustments for timing differences between when cash was received or when cash was paid, or if we have some items in the income statement that actually don't even impact cash. And a great example of that is depreciation expense. So to demonstrate this, let's think back about the journal entry for depreciation expense. The journal entry for depreciation included a debit to depreciation expense and a credit to accumulated depreciation. So if we're going to look at this journal entry, we notice that there is no cash being affected by this entry. So this is a non-cash journal entry. So in that case, because the depreciation expense reduced the net income, we need to add back the depreciation expense as a reconciling item to net income. So I'm going to scroll down a little bit so that way we can start this part of our statement of cash flows using our indirect method. In this problem, we're told that we're going to prepare the operating activity section for the year ended December 31st using the indirect method. So I'm going to select the year, and I'm going to start off with my cash flows from operating activities. And with the indirect method, my beginning part will be our net income, which will be $162,180 in my example. Then I'm going to have some adjustments to reconcile net income to the net cash provided by operating activities, because at the end of this entire process, I want to determine the actual net cash provided or used by the operating activities. So if it is positive, which we typically expect for operating activities, then we would use the word provided. If it is negative, that means that we used more cash than what was collected from normal transactions with our customers. then it would be using the word used. So please make sure that you pay attention to the wording in the drop-down menu. So the first reconciling item is going to be depreciation expense, and we're going to add the depreciation expense. So I'm going to include the dollar amount here. Then we're going to be looking at our timing differences for the other items in our balance sheet. So for example, in this problem, the whole statement of cash flows is going to explain the changes in cash. But when it comes to accounts receivable, if your accounts receivable goes up, that means that you've made sales to customers, but you haven't collected that cash yet. But if it goes down, that means that you have actually collected more cash from your customers. So what we do with our indirect method is we kind of take a shortcut. And this is a method that is widely used by a lot of companies. And we need to look at what is the dollar change from one period to another period from the balance sheet. And this dollar change in our problem, we're going to compute this by taking 2017 numbers minus the 2016 numbers. All right. So for cash, you can include that dollar difference, but you don't have to. But we're mostly going to focus on the line items that are going to be affected by our operating expenses. So if we look at our accounts receivable, in your calculator, you would take 84,800 minus 94,340. And you notice that there is a decrease in accounts receivable of 9,540. Then you look at your next item. You notice that inventory also decreased. So your decrease in inventory when you compute this is 4,240. And then you calculate your change in prepaid expenses. Prepaid expenses actually increased. By, and you'll want to type this in, 5,300. So those are the changes in your current assets. Then you want to look at your changes in your current liabilities. So your accrued expenses payable. Your accrued expenses payable increased and when you determine the dollar amount increase, it's 10,600. And then we have a decrease in accounts payable. And this decrease is going to be 7,420. So we're going to be looking at our changes in our current assets and our changes in our current liabilities. And I'm just moving these notes over to the side. That way when we scroll down, we still have the data from our problem. All right. So now we're going to include these items to reconcile the net income to the net cash provided by operating activities. And there's a little bit of a trick here, okay? So when it comes to your accounts receivable, we notice that there is a decrease in accounts receivable. So that decrease in accounts receivable is going to be added. And the reason for that is that we have an increase in our cash flows because we actually received most of the accounts receivable. If you think back to the journal entry for accounts receivable, you're going to debit cash and credit accounts receivable when you actually collect cash. So if your accounts receivable is going down, that means that you're collecting cash. Then we have our decrease in inventory. So with the decrease in inventory, your inventory will decrease as you make sales, and your inventory will stay low if you do not spend more money to replenish that inventory. So that decrease in inventory is going to have an effect of increasing your cash flow because you're not replenishing that inventory. And you sold it, so that means you collected cash. Then we look at our increase in prepaid expenses. And our increase in prepaid expenses means that you paid cash in advance for your future expenses. So because you spent more cash, that is going to be an outflow, and you need to subtract this amount. So a little hint to help you remember the way it works for the current assets. When you have an increase in current assets, you're going to subtract it. Because that means that for accounts receivable, if your AR goes up, that means you haven't collected cash from your customers yet. We just had an example with prepaid expenses. If that goes up, that means that you paid more cash in advance. And with our inventory, if that increases, that means that you have not sold your inventory yet, or you purchased more inventory. So that means that you spent more cash. So the opposite will hold true when you have a decrease in your current assets. For your current liabilities, we notice that there is an increase in our accrued expenses payable. So that means you have to pay it still. So you haven't spent the cash yet, so you're going to add that, but you've already expensed it in your net income. And then you have an decrease in your accounts payable. And you can think of your accounts payable as all the amounts that you owe. If you have paid off your bills, then that means that your accounts receivable is going down. So that will be a cash outflow denoted by the negative sign. So then you're going to take a subtotal of all of these reconciling items. I've already done the math, and that is $40,280. So make sure you type in the numbers carefully to add and subtract. And then you're going to take your net income, and then you're going to add or subtract the reconciling items to get to your positive number for your net cash provided by operating activities. So one quick note I wanted to add was for the current liabilities. When we have an increase then we're going to add, and the opposite will hold true when you have a decrease. So for your current liabilities, it's going in the same direction. And this is a good tip just to write down. So if you think about it, your current assets are typically going to be accounts receivable, inventory, prepaid expenses. You'll notice that your property, plant, and equipment and investments are not included in the operating activities because they're included in the investing activities. And for the current liabilities, you will typically see your accrued expenses payables and your accounts payable. Because the other items that you see in liabilities, such as a notes payable or a bonds payable, would belong in the financing activities section. And of course, equity would belong in the financing activities section. So thank you for taking the time for watching this video.